What if I told you the difference between immense wealth and retiring broke is not intelligence but avoiding 7 specific mistakes? And what if those mistakes are the very things society and financial experts tell you are responsible choices? I observed my associate transform $10,000 into $12 billion across 6 decades. I witnessed him accomplish this absent of fortune, lacking privileged information, and without any unique brilliant maneuver that you or I would be unable to duplicate. In those same 60 years, I also witnessed thousands of smart, diligent, and well-schooled individuals who earned significantly more income than we did in any given year, yet they concluded with virtually nothing. Physicians earning $500,000 annually who retired with no assets. Attorneys charging $400 per hour who passed away while in debt. Engineers, executives, entrepreneurs, individuals far more intelligent than I am in their specialized fields who amassed nothing despite decades of substantial income. The distinction was not cognitive ability. It was not their work ethic. It was a small number of choices they made regarding where to allocate their capital. More precisely, there were 7 categories of investments they channeled wealth into, which I completely sidestepped. This was not due to my own brilliance, but because I had examined the mathematics, researched the history, and observed a sufficient number of people lose enough money to identify a recurring pattern. What I am preparing to share with you is not theoretical. It is not a forecast. It is an observation drawn from 7 decades of monitoring capital move from one pocket to another and identifying which pockets consistently seemed to deplete while others compounded without pause. These 7 investments obliterated more wealth among individuals I knew personally than market downturns, misfortune, and poor timing combined. The tragedy is that most of them were adhering to conventional wisdom, performing exactly what financial advisors, parents, and society informed them was the intelligent, secure, and responsible decision. The initial destroyer of wealth I avoided my entire life was something 90% of Americans acquired enthusiastically. It was something financial advisors structured entire careers around selling. It was something that carried the very word investment in its name, despite being one of the worst investments ever devised. Whole life insurance, universal life, variable life, every variation of permanent life insurance that promised to merge insurance protection with investment accumulation. The sales proposition was alluring. You require life insurance regardless, they would assert. So why not acquire a policy that accumulates cash value you can borrow against or access in retirement? You are not merely purchasing protection, they claimed. You are cultivating an asset, tax-exempt appreciation, assured returns, the security of insurance, blended with the expansion of investments. It appeared flawless. It was a mathematical toxin. Here is what they failed to articulate plainly. When you acquire whole life insurance, approximately 50 to 100% of your initial year's premiums are directed straight to the agent as commission not into your cash value, but into their pocket. You remit $5,000, they receive $5,000. You obtain insurance coverage and essentially zero in your cash value account. Over the subsequent decade, the insurance corporation slowly and reluctantly starts allocating a portion of your premiums to this purported investment account, but only after subtracting insurance costs, administrative fees, mortality charges, and their own profit margins. By year 15 or 20, if you are fortunate and have not relinquished the policy due to frustration, you might possess a cash value equivalent to what you have contributed. Might. The returns they promoted 4%, 5%, sometimes greater, were not returns on your total premiums paid. They were returns calculated on the cash value after all those expenses had been deducted. I observed a friend contributing $5,000 annually to a whole life policy from age 30 until age 60. That is 30 years, totaling $150,000 in premiums. His cash value at 60 years old was $168,000. That represented $18,000 of growth over 30 years. That equates to a 0.4% annual return. If he had, instead, purchased $20 per month term insurance for the identical death benefit and invested the difference, $4,760 annually, into the stock market, which averaged 10%, he would have possessed $870,000. The disparity between $168,000 and $870,000 is $702,000. That is what whole life insurance cost him. Not in fees, but in opportunity cost in wealth. He could have constructed but failed to, because someone persuaded him that insurance and investment belonged in the identical product. They do not. Insurance is for relocating risk. Investment is for constructing wealth. Combining them is akin to purchasing an automobile that is also a boat. It performs both functions inadequately, costs more than acquiring each one individually, and the salesperson earns a fortune selling it to you. I never purchased permanent life insurance. I acquired inexpensive term insurance when my children were young and I possessed obligations. When I had amassed sufficient wealth that my passing would not financially ruin my family, I permitted it to expire. The capital I did not squander on whole life insurance compounded in enterprises and equities for 50 years. That single decision likely contributed 8 figures to my net worth. Not because I was intelligent, but because I recognized that when an individual's compensation hinges on you purchasing something, their counsel regarding whether you should purchase it is valueless. The whole life insurance industry is constructed upon an elegant scam. Take people's genuine need for protection. Inject complexity in terminology they do not comprehend. Pay salespeople enormous commissions to promote products people do not require. And envelop all of it in the language of financial responsibility. Providing for your family, building your future, being a responsible adult. It is truly genius. They took the worst investment vehicle ever devised and persuaded an entire generation it was prudent. I observed this same friend, the one who amassed $168,000 in cash value over 30 years, defend his whole life policy even after I presented him with the mathematics. He had been remitting premiums for 25 years when we had this discussion. I posed a simple query to him. If you could return to age 30, possessing the knowledge you have now, would you acquire this policy again? He deliberated for a long moment. No, he conceded, absolutely not. So why, I inquired, are you persisting in paying premiums now? Because I have already invested so much, he stated. I cannot just abandon 25 years of payments. That is when I knew the insurance corporation had prevailed. They had persuaded him that continuing a detrimental investment was somehow superior to acknowledging he had erred and redirecting his capital to something that genuinely constructed wealth. It is the sunk cost fallacy in its most unadulterated form, and it keeps individuals ensnared in wealth-destroying products for decades. The insurance agent who sold him that policy earned $50,000 in commissions over the policy's duration. My friend earned $18,000 in growth. The insurance corporation earned hundreds of thousands in profit. Everyone earned money except the individual who actually needed to construct wealth. That is not an investment. That is a relocation of wealth from the financially unsophisticated to the financially predatory. The second asset class I sidestepped was one that people used to construct their retirement fantasies. It was something society regarded as the cornerstone of financial security. It was something that merges immense leverage with illiquid assets and transaction fees that would cause a predatory lender to blush. I am referring to real estate. This does not mean your primary residence. I will cover that topic independently. I am referring to investment real estate, rental properties, vacation homes, you convince yourself are investments, commercial structures, real estate investment trusts. The entire doctrine of property ownership as a path to wealth accumulation. The sales proposition was even more alluring than life insurance because it arrived enveloped in the American dream. Acquire property, observe it, appreciate, gather rent, construct equity, utilize other people's money via mortgages, and retire wealthy. I heard this assertion 10,000 times. I observed hundreds of individuals pursue that path, and with remarkably few exceptions, namely, people who acquired vast quantities of property in high-growth locales and retained them through numerous market cycles, it destroyed wealth when compared to simply holding ownership in businesses through stocks. Here are the mathematics nobody addresses when they are promoting real estate to you. Initially, transaction costs. When you acquire property, you remit closing costs, averaging 3 to 5%. When you divest, you pay realtor commissions, averaging 6%. Purchase a $500,000 property, and you are instantly down $15,000 to $30,000 merely in transaction fees before you have gathered a single dollar of rent or appreciation. Contrast that with acquiring stocks. There are zero transaction costs with contemporary brokerages. Second, carrying costs. Property taxes in most states typically run 1 to 2% of the property's value annually. Homeowners insurance adds another 1%. Maintenance averages 1 to 2% annually, and that assumes no major systems fail. You are paying 3 to 5% of the property's value every single year just to possess it. A $500,000 property costs you $15,000 to $25,000 annually in taxes, insurance, and upkeep. That is before accounting for mortgage interest if you are leveraged. Third, illiquidity. When I wish to sell an equity position, I click a button and possess cash in my account within 2 days. When you wish to sell a property, you list it, await a buyer, negotiate, enter escrow, and if you are fortunate, you possess cash in 90 days. If you are unfortunate, experiencing incorrect market timing or an economic downturn, you wait years or sell at a loss. Fourth, depreciation and obsolescence. Property ages. Roofs require replacement. HVAC systems fail. Neighborhoods evolve. Businesses I possess through stocks do not have roofs that leak, tenants who cease paying rent, or foundations that crack. They have earnings that compound. Fifth, leverage operates in both directions. People adore discussing the use of mortgage leverage to control a $1 million property with $200,000 down. What they neglect to mention is that if the property's value declines by 20%, you did not lose 20%. You lost 100%. Your $200,000 of equity vanished to zero. I observed this occur among brilliant individuals in 2008. Physicians, attorneys, and engineers who had amassed millions in home equity and rental properties, all leveraged, all convinced real estate only appreciates, lost everything. This was not because they were unintelligent. It was because they failed to grasp that leverage magnifies losses just as aggressively as it magnifies gains. I analyzed the figures back in 1965, and the numbers were unambiguous. Over extended time frames, stocks surpassed real estate by approximately 2 to 3 percentage points each year. That may not sound like a significant amount. Over 40 years, however, it represents the difference between $1 growing into $15 or $45. It is the distinction between a comfortable retirement and generational wealth. But everyone desired real estate because they could see it, touch it, and drive past it. They could not visualize ownership in an enterprise. Consequently, they acquired property and dedicated their weekends to repairing toilets and managing tenants. Meanwhile, I acquired stocks and dedicated my weekends to reading. 40 years later, I possessed more wealth and more time. They possessed property that had appreciated roughly in line with inflation and decades of recollections of handling problematic renters. Now, allow me to be precise about what I am not asserting. I am not asserting that home ownership is detrimental. I am not asserting that property has no function in a portfolio. I am asserting that for the majority of individuals, investment real estate is a snare disguised as an opportunity. It appeals to our yearning for tangible assets, our conviction that we can observe and manage our investments, and our cultural mythology surrounding property ownership. But the mathematics are unforgiving. An acquaintance of mine acquired 3 rental properties during the 1990s. He paid about $200,000 apiece for a $600,000 total. He spent 20 years overseeing them, handling repairs, evictions, property taxes, and insurance claims. He sold them in 2015 for approximately $350,000 each, totaling roughly $1 million. It sounds like a victory, correct? He more than doubled his capital. Except when you incorporate all the carrying costs, property taxes, insurance, maintenance, vacancy periods, property management, if he enlisted help, his genuine return was about 4% annually. And that figure does not account for the hundreds of hours he dedicated to addressing tenant issues, repair emergencies, and administrative burdens. If he had taken that same $600,000 and purchased an S&P 500 index fund, he would have possessed approximately $2.4 million by 2015, with zero time investment and zero tenant phone calls at 3 o'clock in the morning regarding broken water heaters. The disparity between $1 million and $2.4 million is $1.4 million, plus 20 years of his life he spent serving as a landlord instead of doing literally anything else. That is the opportunity cost nobody calculates when they are acquiring rental property. The third asset I sidestepped was something even more culturally revered than real estate. It was something people literally waged war over for thousands of years. It was something that is purported to be the ultimate store of value and a safeguard against catastrophe. This refers to gold, silver, precious metals, commodities that yield nothing, generate no cash flow, create no value, and reside in a vault somewhere while you hope another person will pay you more for them tomorrow than you paid today. This might be the most illogical investment humanity ever devised. And I spent 7 decades observing intelligent people pour wealth into it for justifications that disintegrate under the mildest logical examination. Here is the case made for gold. It has held value for 5,000 years. It serves as a hedge against inflation. It is a crisis hedge for when paper currency becomes valueless. It is tangible and finite. Governments cannot print additional quantities of it. All of that is factually accurate. It is also entirely irrelevant to constructing wealth. Allow me to guide you through the actual mathematics of gold ownership. From 1975 to 2023, a span of 48 years, gold increased in value from around $165 per ounce to approximately $2,000 per ounce. That is approximately 12 times your initial capital, which sounds impressive until you contrast it with literally any productive asset. The stock market during that identical time frame increased roughly 90 times. $1 placed in stocks in 1975 became $90. $1 placed in gold became $12. But it is actually worse than that, because gold possesses carrying costs. If you acquire physical gold, you must store it somewhere protected. If you store it at home, you risk theft. If you store it in a safe deposit box or a vault service, you pay annual fees. If you acquire gold through an exchange-traded fund, you pay management fees. Thus, that 12 times return gets diminished to perhaps 10 times after accounting for carrying costs. Meanwhile, stocks provided dividends that compounded over those 48 years, transforming that 90 times return into something nearer to 150 times, assuming dividends were reinvested. The gap between gold and stocks is not merely substantial. It is generational wealth versus modest gains. But individuals do not acquire gold for returns. They acquire it for safety, for crisis insurance, for the conviction that when everything collapses, gold will retain value. Let me tell you what truly occurs in a crisis. I experienced the stagflation of the 1970s, Black Monday in 1987, the dot-com collapse, the 2008 financial crisis, and the pandemic. Do you know what possessed value in every single one of those crises? Ownership in productive businesses. Companies that manufactured products people required, delivered services people desired, and generated cash flow irrespective of what currency was doing. Gold spiked momentarily during some of those crises, then receded. Businesses continued to produce earnings. Here is the fundamental issue with gold that nobody wishes to concede. It is not an investment, it is speculation. Investment signifies placing capital into something that yields a return, a business that generates profit, a bond that pays interest, real estate that generates rent. Gold just sits there. You acquire it, store it, and hope someone pays you more for it later. That is not investing. That is the greater fool theory. You are wagering that a greater fool will pay more than you did for something that produces nothing. I never acquired gold, not 1 ounce. Not as a hedge, not as insurance, not as a speculation. Every dollar I could have allocated to gold was allocated to businesses instead. Over 7 decades, that decision compounded into a wealth disparity so vast that I cannot even calculate it with precision. If I had allocated 10% of my net worth to gold back in 1965, which many financial advisors suggested, I would possess millions less today. Millions. And I would have spent 7 decades fretting about whether civilization was impending collapse instead of reading annual reports and learning how businesses operate. The psychological toll of gold ownership is something nobody discusses. Gold enthusiasts are the most paranoid, pessimistic, and perpetually disappointed investors I have ever encountered. They are constantly awaiting the collapse, the hyperinflation, the currency crisis that will ultimately validate their position. Meanwhile, the world keeps operating, businesses keep producing, and the stock market keeps compounding. I once asked a gold investor what would need to happen for him to concede. Gold was a detrimental investment. He could not reply, because for true gold adherents, there is no falsifiable hypothesis. If gold appreciates, they were correct. If gold depreciates, it is temporary manipulation, and they should acquire more. If gold moves sideways for decades, it is preserving value while everything else exists in a bubble. It is the perfect unfalsifiable investment thesis, which means it is not an investment thesis at all. It is a religion. And, like most religions, it makes people feel secure without actually enhancing their material circumstances. The fourth asset I sidestepped was one that merged the most detrimental characteristics of whole life insurance and real estate: excessive fees, illiquidity, substandard returns, and a complexity that masked how poor the arrangement truly was. This includes actively managed mutual funds, hedge funds, private equity funds, any investment vehicle where you compensate someone else, usually 1 to 2% annually, plus performance fees, to invest your capital on your behalf. This might be the most profitable scam in financial history, and it succeeded for decades because it appealed to a fundamental human vulnerability, the conviction that experts can achieve what we cannot, and that superior returns are worth paying for. Allow me to dismantle that conviction with mathematics. The average actively managed mutual fund assesses about 1.3% in yearly fees. That may not seem substantial. It is scarcely perceptible on your quarterly statement. But over 30 years, that 1.3% fee costs you roughly 35% of your total returns, not 35% of your fees, 35% of your wealth. If the market provides 10% annually, and you are paying 1.3% in fees, you are not receiving 8.7%. Because of compounding, you are receiving about 6.5%. And that assumes your fund manager equals the market return before fees, which 95% of them do not over extended time frames. The actual data is devastating for the active management industry. Over 15-year time frames, approximately 92% of active fund managers underperform their benchmark index after fees. Over 20-year time frames, it is 95%. Over 30 years, it nears 98%. This means if you select an actively managed fund, you possess a 2% probability of defeating a simple index fund that assesses 0.03% in fees and demands zero expertise to acquire. Those are not odds. That is a certainty of underperformance. But the mutual fund industry is a $3 trillion business. Therefore, they are very adept at clarifying why you should disregard the data. They display the funds that did defeat the market, ignoring survivorship bias, the hundreds of funds that shuttered because they performed so inadequately. They display past performance, ignoring that past performance does not forecast future results. They sell you on the expertise of their managers, ignoring that genius does not overcome a 1.3% annual hindrance plus underperformance. I observed colleagues invest in hedge funds during the 1980s and 90s, when hedge funds were the fashionable new item. A 2% annual management fee plus 20% of profits above a specific threshold. The proposition was that these managers were so adept, so connected, so intelligent that they could generate returns that would dwarf the market, even after those enormous fees. Some did, for a time. Most never did. And even the ones that generated superb returns experienced a curious phenomenon. As they expanded and attracted more capital, their returns regressed toward the mean. The advantage vanished, but the fees did not. I encountered a hedge fund manager in 2003 who produced 30% annual returns for 5 years. A brilliant individual. Wharton MBA, worked at Goldman Sachs, possessed a proprietary trading system he had formulated. He was managing about $50 million. I asked him what he anticipated would occur to his returns if he had $5 billion to manage instead of $50 million. He became very silent. Then he conceded that his strategy would not scale. His advantage existed in small, inefficient segments of the market that could not absorb substantial capital flows. If he had $5 billion, he would be forced to invest differently, and his returns would likely decline to 15%, perhaps less. But he would still assess 2 and 20 on that $5 billion, which meant he would personally earn over $100 million per year, even if his investors only received 12 or 13% after fees. That is when I grasped that the hedge fund business was not centered on making investors affluent. It was centered on making hedge fund managers affluent. The incentive structure was perfect for them and dreadful for investors. They were compensated based on assets under management and performance in positive years, but did not return money in negative years. Heads, they win. Tails, you lose. I never invested $1 in a hedge fund. I never acquired an actively managed mutual fund once index funds became accessible. Every dollar I might have provided to an expert manager was instead allocated to low-cost index funds or individual stocks I investigated myself. Over 40 years, the disparity was likely $50 million or more in my personal net worth. This was not because I was more intelligent than hedge fund managers. It was because I was not compensating them 1 to 2% annually to underperform what I could obtain for 0.03%. The mathematics of fees is the most critical concept in investing that nobody is taught. If you have $1 million invested and pay 1.3% in fees annually after 30 years at 10% market returns, you will have about $13 million. If you invest that same million in an index fund assessing 0.03%, you will have about $20 million. That is a $7 million disparity resulting from 1.3%. That is not a rounding discrepancy. That is generational wealth relocated from you to the financial services industry. And people remit it gladly because they do not comprehend that compounding operates in both directions. It compounds your returns and it compounds your fees. The industry recognizes this. That is why they direct your focus toward performance and mask the fee structure. That is why they report returns before fees in their marketing materials. That is why they make fee schedules intricate and difficult to compare. They are not endeavoring to make you affluent. They are endeavoring to extract maximum fees while delivering minimum value, and they have been achieving it successfully for 70 years. The fifth asset I sidestepped was one that did not exist for the majority of my career, but detonated in the 2000s and emerged as the defining speculative frenzy of the 21st century. This was cryptocurrencies. Bitcoin, Ethereum, and whatever novel coin was being promoted this week as the future of money. I observed this unfold with a blend of fascination and horror, because it merged every component of financial delusion I had witnessed in 7 decades. The tulip mania, the South Sea bubble, the dot-com collapse. The conviction that this time is different, that the principles of economics do not apply, that you can become affluent without yielding anything of value. Allow me to be extremely clear regarding my perspective on cryptocurrency. It is not currency, because nobody employs it to purchase things. It is not a store of value, because it oscillates wildly. It is not a productive asset, because it generates no cash flow. It is not a commodity, because it possesses no industrial application. It is a digital token whose sole value is what another person will pay for it, rendering it the purest form of greater fool speculation ever devised. The arguments supporting cryptocurrency disintegrate under minimal examination. First, the scarcity argument. Bitcoin is restricted to 21 million coins, they assert, which makes it intrinsically valuable. Scarcity does not create value. Usefulness creates value. I can devise a limited digital asset right now. There will only ever be 21 million Mare coins in existence. Does that render them valuable? Of course not. Scarcity combined with demand creates value. And the sole demand for cryptocurrency is speculative demand. People acquire it hoping someone will pay more tomorrow. That is not value. That is musical chairs. Second, the decentralization argument. Cryptocurrency is free from government oversight, they assert, which makes it superior to fiat currency. Setting aside the reality that most cryptocurrency transactions occur via centralized exchanges that governments can and do regulate, allow me to pose a simple query. Why is freedom from government oversight valuable? The reply crypto enthusiasts provide is that governments debase currency through inflation, which is true. But the alternative they are proposing, a deflationary currency that appreciates in value over time, creates its own immense problems. If your currency becomes more valuable merely by retaining it, nobody spends it. Economic activity grinds to a standstill. We know this from history. The gold standard created deflationary spirals that resulted in depressions. That is why every developed economy transitioned to fiat currency, not because governments desired control, but because deflationary currencies do not function as mediums of exchange. Third, the blockchain technology argument. Even if cryptocurrency fails, they assert, blockchain technology will revolutionize everything. Perhaps, but you do not need to possess Bitcoin to profit from blockchain technology, any more than you needed to possess pets.com to profit from the internet. Most transformative technologies do not make their initial investors affluent. They improve their users' lives and create value in unforeseen places. The internet did not make most internet investors affluent. It made Amazon and Google and Facebook affluent, and most of those corporations did not exist when the internet boom was occurring. I observed Bitcoin travel from $1,000 to $20,000, down to $3,000, up to $60,000, and back to $20,000 again. Every boom attracted new investors, persuaded they had discovered the secret to effortless wealth. Every bust obliterated those investors and prepared the stage for the next boom. It is a perfect cycle of avarice and fear, and the only consistent winners are the early adopters who entered at pennies and the exchanges that gather fees on every transaction. I never acquired cryptocurrency. Not $1. Not as a speculation, not as a hedge against government currency, not because I believed I grasped the technology. Every argument I heard for why I ought to acquire it sounded precisely like arguments I had heard in 1999 regarding why I ought to purchase pets.com and Webvan and eToys. Revolutionary technology, first mover advantage, network effects. The old economy does not comprehend the new rules. All of it was true regarding the technology, and all of it was irrelevant to the investment returns. The companies entered bankruptcy. The technology flourished. The same phenomenon will occur with cryptocurrency. Some iteration of blockchain technology will likely become infrastructure we all utilize without considering it, much like TCP divided by IP protocols. And the individuals who acquired Bitcoin at $50,000 will have lost most off their capital because technology, revolutions, and investment returns are distinct concepts. Great technology often makes for dreadful investments. The optimal time to invest in a technology is not when it is revolutionary and thrilling and everyone is discussing it. It is when it is mundane and profitable and yielding cash flow. Amazon was not a sound investment in 1999 when everyone was discussing it. It was a sound investment in 2003, after it had crashed, refined its business model, and commenced generating consistent profits. Cryptocurrency has no pathway to profitability because it is not a business. It is a speculative token, and speculative tokens ultimately revert to their intrinsic value, which, in the case of something that produces nothing and performs no useful function, is approximately zero. People become angered when I state this. They inform me I do not comprehend the technology, that I am old and fearful of innovation, that I miss the opportunity of a lifetime. Perhaps, but I have been hearing that I do not understand the next big thing for 70 years. And I observe the people who claim to understand it lose fortunes, while I compounded wealth in mundane businesses that manufactured products and generated profits. I will accept that trade every time. The sixth asset I sidestepped was one paradoxically popular among individuals who regarded themselves as sophisticated investors, people who had read the correct books, grasped the theory, and wished to optimize their returns with scientific precision. This refers to individual bonds, corporate bonds, municipal bonds, treasury bonds, any fixed income security where you loan money to an entity in exchange for a guaranteed interest rate. On the surface, bonds appear to be the most secure, most rational investment achievable. You know precisely what you will be paid and precisely when. No volatility, no uncertainty, just steady, predictable returns. The issue is that steady, predictable returns constitute steady, predictable wealth destruction once you incorporate inflation and taxes. Allow me to demonstrate the mathematics. A 10-year Treasury bond currently yields approximately 4%. This seems reasonable, but inflation is progressing at about 3% annually. Therefore, your real return after inflation is 1%. Then, taxes. If you are in the 37% tax bracket, which most high earners are, you remit 1.48% of that 4% to the government, leaving you with 2.52%. Subtract 3% inflation from a 2.52% nominal return, and your real after-tax return is negative 0.48%. You are losing purchasing power. You are becoming poorer slowly and predictably, but bonds are safe, people assert. You get your principal back. That is accurate in nominal terms and entirely false in real terms. If you invest $100,000 in bonds, yielding 4% for 30 years, you will have your $100,000 back, plus your interest payments. But that $100,000 will purchase what about $41,000 purchases today, following 3% annual inflation. You preserved your nominal capital, yet lost 59% of your purchasing power. That is not safety. That is guaranteed impoverishment. The only time bonds were logical as an investment was when interest rates exceeded inflation plus taxes. That occurred in the early 1980s when Paul Volcker raised rates to combat inflation, and you could acquire treasury bonds yielding 15% when inflation was 10%. A 5% real return was worth contemplating. But those conditions existed for perhaps 5 years out of the preceding 50. The remainder of the time, bonds were wealth destruction mechanisms marketed as safe investments. I observed friends in the 1990s and 2000s construct bond portfolios because their financial advisors informed them that, at their age, they required safety and predictability. Those friends retired with portfolios that generated $50,000 or $60,000 in annual income from bonds. That sounds comfortable until you recognize that $50,000 purchases what $25,000 bought when they retired. Their income remained flat while their cost of living doubled. Meanwhile, I maintained 100% of my investable assets in equities, productive businesses that increase prices, commensurate with inflation, expand earnings, and raise dividends. My income in retirement grew at 8 to 10% annually. This was not because I was assuming more risk. It was because I grasped that the safest, long-term investment is ownership in productive assets, not loans to borrowers at fixed rates. The bond industry, much like the insurance industry and the mutual fund industry, exists primarily to relocate wealth from unsophisticated investors to financial intermediaries. When you acquire a bond through a broker, you pay a spread the difference between what the broker paid for the bond and what they sell it to you for. That spread is frequently 1 to 3% of the bond's value, which, on a bond yielding 4%, means you just relinquish the first year's interest to your broker. Then you pay taxes on the interest every year. Then inflation erodes the purchasing power of your principal. After all those costs, you are fortunate to break even in real terms. But bonds feel safe because they do not oscillate in value the way stocks do. This is the greatest psychological deception in finance, convincing people that nominal stability is identical to real safety. A stock portfolio might decline 30% in a difficult year, but over 30 years, it will compound at 8 to 10%. A bond portfolio might never decline in nominal value, but over 30 years, it will forfeit 2 to 3% annually to inflation and taxes. Which one is genuinely safe? The one that rendered you wealthier, or the one that felt stable while rendering you poor? I never allocated more than a minuscule fraction of my wealth to bonds, and that was solely for liquidity, possessing cash accessible for opportunities without needing to sell stocks at unfavorable times. The outcome would be financial independence by my 50s and wealth by my 60s, irrespective of starting income, irrespective of luck, and irrespective of market timing, because the mathematics of compound interest are undefeated. 8% annual returns double your capital every 9 years. In 30 years, that equates to 3 doublings. $1 becomes $8. $100,000 becomes $800,000. Bonds do not accomplish that. Bonds are a wager that the future will be inferior to the past, that economic growth will decelerate, that businesses will cease innovating. It is a profoundly pessimistic investment thesis, and pessimism is costly. Optimism, the conviction that human ingenuity will persist in creating value, has been the only rational investment thesis for all of human history. I selected optimism. I selected businesses. I selected stocks. And I concluded far wealthier than the individuals who selected safety and predictability and bonds. The seventh and ultimate asset I sidestepped was perhaps the most emotionally challenging to resist, because it was not marketed as an investment whatsoever. It was marketed as a lifestyle decision, a marker of success, a recompense you merited after years of hard work. New automobiles, luxury vehicles, vehicles that depreciate the instant you operate them off the lot. This might seem like a peculiar item to incorporate in a list of investments, but that is precisely the point. People treat cars like investments. They finance them, trade them in, and upgrade them, when in reality, they are one of the worst financial decisions you can render. Allow me to show you the genuine cost of a new automobile. The average new car in America costs about $48,000. Most individuals finance it over 5 or 6 years at 5 to 7% interest. By the time the loan is paid, you have spent $54,000 to $57,000 when you factor in the interest. But that is not the genuine cost. The genuine cost is the opportunity cost. What that capital would have become if you had invested it rather than spending it on a depreciating asset. $48,000 invested at 10% annual returns becomes $124,000 in 10 years. It becomes $314,000 in 20 years and $815,000 in 30 years. That is not a rounding discrepancy. That is retirement security. That is your children's education. That is financial independence. And you expended it on an automobile that is worth perhaps $15,000 after 10 years. But people do not contemplate it this way because cars are not optional. And new cars feel like the responsible decision. You need reliable transportation. New cars do not break down. You get a warranty. Old cars cost more in maintenance. Every one of those assertions is a rationalization that disregards the mathematics. If I were commencing again today with nothing, here is what I would do. I would acquire term life insurance if I had dependents, and zero permanent insurance ever. I would rent a modest home or acquire a small home I could pay off swiftly and invest every dollar I did not expend on real estate into index funds. I would acquire zero gold, zero cryptocurrency, and zero individual bonds. I would invest in the lowest cost index funds accessible, likely a total market index fund, and never sell. I would acquire a reliable used automobile and operate it until it expired, then acquire another reliable used automobile. And I concluded far wealthier than the individuals who selected safety and predictability and bonds. The seventh and ultimate asset I sidestepped was perhaps the most emotionally challenging to resist because it was not marketed as an investment whatsoever. It was marketed as a lifestyle decision, a marker of success, a recompense you merited after years of hard work. New automobiles, luxury vehicles, vehicles that depreciate the instant you operate them off the lot. I would sidestep every financial advisor who assesses a percentage of assets under management. I would read annual reports and learn how businesses operate instead of watching financial news. I would expend money solely on things that yielded value: education, health, relationships, tools that enhance my earning power. I would save a minimum of 50% of my after-tax income. And I would persist in this for 30 years without deviation. $500,000 becomes $4 million. The only query is whether you can sidestep the 7 wealth destroyers long enough to permit compounding to work. Most people cannot. They get sold whole life insurance in their 30s. They acquire investment real estate in their 40s. They panic into gold during a crisis. They remit mutual fund fees for decades. They speculate on cryptocurrency. They conceal themselves in bonds for safety. They acquire new automobiles every 5 years. And they retire at 65 with less than they would have possessed if they had simply acquired an index fund at 25 and never touched it. That is the tragedy. The solution is simple, free, accessible to everyone, and demands no specialized knowledge or expertise. But it demands the one thing most people cannot sustain: the willingness to disregard conventional wisdom, resist social pressure, delay gratification, think in terms of decades, and be boringly consistent. I spent 70 years being boringly consistent. I avoided the 7 wealth destroyers. I acquired productive assets and retained them forever.